Good morning, ladies and gentlemen, and welcome to this, the first in the series of Financial Times Economics class videos. This week, we're looking at the article entitled Japanese Investors, UK Government Bonds at Record Rate in Early 2021. Obviously, a very important, very pertinent article given what is going on, not just in the UK, but globally, as countries find the will and the way and the wherewithal to finance their pandemic response. So let me just pull up the article. There it is there. I'm not going to read it through with you. You can obviously read that yourselves. But what I do want to do is I just want to point you in the direction of a few resources that you might find useful. So question one is a very straightforward introductory question. Explain why the UK government issues bonds. Now, I would recommend and advise you and I'd point you to this website, www.dmo.gov.uk. So the DMO is the Management Office, so the government's debt management office. And here's the website. And if you scroll down, you'll be able to see there's a link here on the left-hand side to the gilt market. As you know, I'm sure government bonds are often referred to also as gilts. And by following that link through, you'll get a lot of information there with regard to what gilts are, how long they've been issuing them, and what gilts are used for. So, nice straightforward one for question one. Let's move on then to question two. So what proportion of UK bonds are held by overseas investors? It's an interesting question, isn't it? Who's buying these bonds? Why are they buying them? What incentive do they have to buy them? And if you have a little leaf through that article, you'll see that I've just lifted a couple of quotes out. So it talks about the fact that pension funds and life insurers are investing in these government bonds, the UK government bonds, and overseas investors hold just over, and then it goes into giving you a little percentage as to how much of those are actually holding. So again, that's more sort of a straightforward comprehension style question, but of course you'll have to read the article to get the info. So now we move into questions 3 and 4. Question 3, where we are, of course, looking at kind of economic analysis, and similarly for question 4. So question 3, the chart illustrates that Japanese investors have been buying UK government bonds at a, quote, record clip. That's exactly what it says in the article. Using a diagram, analyse the effects of this buying spree on the UK bond market. And so you can see here what I'm doing is I'm thinking to myself, okay, the UK bond market, we're talking demand and supply, very straightforward micro here to get you going. And then you need to be thinking to yourselves, okay, if lots of overseas investors are buying these, particularly Japanese investors in the case of this article, what's going to be happening on the demand curve, particularly, and hence what will happen on the price side of things. So I'm not going to annotate that. It's a fairly straightforward kind of shift in this instance. But what you do need then to think about, ladies and gentlemen, is think about the price of the bond, which is an obvious one, and you'll be reading that off your chart anyway. But then B, think about what you know between the relationship between the price of the bond and the bond yield or the interest rate on the bond. So something for you to ponder. And again, I'll not say too much more about that at the moment. And lastly, now we move from bonds to kind of bonds and exchange rates and profits and why Japanese investors would be buying these bonds. Hideki Kishida, I hope I've pronounced that correctly, refers to currency risk. Explain why a volatile pound-yen exchange rate would deter Japanese investors from buying UK assets. Okay, so this is an interesting one. This sort of problem was bandied around quite a lot with regard to people in Europe investing in the UK and all the Brexit negotiations and the currency risk involved there. And so here we have a similar kind of thing. So I've got a little example here. And again, I'm not going to give you the answer, but this is something for you to think about. So let's think about a Japanese investor investing in a UK asset, and that yields them a profit of £100. Now, of course, what will they want to do with that? They'll want to repatriate it. They want to, take it back to Japan from the UK. You need to then think about the exchange rate risk and the impact of that exchange rate risk when you're converting the profits in sterling back to the domestic currency of, in this instance, the yen. And so I've just given you a couple of examples here. So think about the exchange rate. Think about what would happen to that £100 profit if the exchange rate was 1-to-1, and then think about what would happen if it was 1-to-4. And then also reverse it. Think about if it was 1-to-4 to begin with, but then change back to 1-to-1. So I'll not say any more about that, but that's something for you to ponder and obviously to incorporate into your answers to these questions. Okay, ladies and gents, I hope you found that useful. That's try one of these videos for FT for Schools, and feedback would be greatly appreciated. So good luck with the questions. Any questions, you can send me a message on YouTube, and I'll do my best to get back to you. Bye for now.